Good evening guys, hope you are all well. Welcome back to a new video. So today's video is going to be breaking down the strategy that got my first funded account. I'm going to go over everything that you need to know regarding the strategy, how you can implement it yourself, so that by the end of this short video, you're going to be able to potentially use this strategy in the markets and hopefully get some funded accounts of your own. So what we'll do, we'll go onto the charts and break it down. So we are now onto the computer. Let's now have a look at the strategy. It's worth noting I was trading this strategy in 2020 and 2021. We had over 400 people in the community at this time, and honestly, the results were insane. So I'm going to basically break down the ins and outs of the strategy, the confluences that we used, and then obviously, hopefully by the end of the video, you are in a position to trade this strategy for yourself. So it's a mechanical strategy, meaning it's a rule-based strategy with multiple things that you need to happen before getting in. It is very simple, so whether or not you're a beginner to trading or someone who has been trading the markets for quite a while, you will be able to understand this. So let's just get straight into it. Time frame wise, this strategy works on all time frames. I personally traded the 15-minute. Based on kind of, what your work-life balance is about. Can you sit in the office all day like I did when we had the office? We'd basically just sit there all day trading. Or alternatively, you might be someone with a job and you can't check the charts every 15 minutes. So it's going to basically depend on your situation for what time frame you trade. For me at the time, I traded the 15-minute, and so did most of the community due to the fact that it was in COVID. My trading hours were 9 a.m. UK time to 5 p.m. UK time. Main reason being, they're just the normal working hours I was in the office. If I got a win, I'd probably leave early and, leave at about 2 or whatever. But usually I was in the office for quite a while, mainly because obviously we was actively trading on charts. London and New York sessions pretty much covered. New York does run a little bit later, but I wasn't interested in staying because obviously I wanted to just get home. And obviously close the office for the day. Confluences wise, it was the Fibonacci, a break and retest, and an EMA, which we are going to go over. And the TP and stop loss are based on the Fibonacci, which we will also go into. So first things first, the confluences. Fibonacci is what we used. I'm going to show you a couple of chart examples after this slide. Entry wise, I was only entering off the 38 and the 61 Fibonacci. I still do use them Fibonacci levels among a couple of others. But obviously, 38 and 61 Fib are the main ones you are going to want to look at when entering. The Fibonacci itself was used based on a recent push within the market. So if we look at this, which is on the screen now, this is the most recent push on the left-hand side for a downwards moving market. And on the right-hand side, we have a market pushing to the upside. Vice versa, we had a Fibonacci from the low up to the high. I do have another video based on Fibonacci's. So if you are someone who is struggling to understand it, by all means, watch that video. And if you do want more in-depth, education and to learn how I currently trade, there is the link in the bio for the training group. So this is basically what we're looking at with the Fibonacci. All you need to do, find the most recent push within the market and go from the low to the high in an upwards market and from the high to the low in a downwards moving market, okay? That is the main reason we are using the Fibonacci. Second thing is we are looking at break and retest of structure within the market. We want to really see a clear break of the high or the low that we're looking at, and then also consecutive candles, meaning consecutive bullish candles or consecutive bearish candles. What I mean by that is what you see on the screen now, is that we are looking for a break and retest of the high on the left-hand side here. All the candles which broke are bullish or blue in this scenario. Yours might be green or whatever color your chart is. And then the pullback candles, as you can see on the right-hand side, are still the same color. So it's basically just an identical move within the market. All candles up, all candles down in an upwards market, and then all candles down, and then all candles up the same color in a downwards moving market. Easy as that. And basically that just means that within this move, there is no additional structure that we need to worry about. So let's say we had 3 bullish candles and then 1 bearish and then a bullish and then a bearish. That is structure on the 5-minute and the 1-minute. That is going to prevent our trade from hitting the high due to all the money, which is obviously in the market in between that level. That's what I found after hours of backtesting. So if you want to question that, by all means you can, but that's what the data said. And I go off the data, not what I think, because that's how you should be trading. Don't trade what you think you see, trade what you see, and trade what the data tells you to do. So using consecutive candles like this, where these are all downwards and then your pullback is all upwards, is the best setup you can take. Yes, they might not be as many, but as you will see at the end of the video, the stats speak for themselves. Another part of the strategy itself is the EMA. This is confluence number 3. The EMA is the 50 EMA, which I've done quite a few videos on the 50 EMA, acting as support and resistance in the direction of your trade. So for example, if we look here, if the market's moving down and we want to take a sell, the EMA should be above our level of interest. Closer to the level, the better, just because, again, if price bounces off the EMA and it's at the level, that's obviously a better entry. Whereas if it goes all the way up here, you might have a little bit of drawdown. Still doesn't really matter. It's just obviously closer to the zone, the better. On the right-hand side, you can see here, identical. If we was looking for a buy example, all you would want to see is the EMA, obviously below price. So if the EMA is below price, you want to be looking for buys. If EMA is above price, you want to be looking for sells, because if price hits that, we would expect a move to the downside or the upside, depending on what way we're obviously hitting the zone. So as you start to piece it together, we've drawn our Fibonacci here from the high down to the low. We've got the 61 Fibonacci up here. We've got the low here for a break retest, and we also have this EMA pushing in. So now there are 3 reasons why price should hit this zone. Okay? If you are entering off the 38 fib, you would want the EMA to be between the 38 and the 61. If you're entering off the 61 fib, you would want your EMA to be obviously higher than that. Okay? So that's exactly what you would be looking at. Stop loss and TP are very, very simple. So trades from the 38 Fibonacci, you want to put your stop loss at the 61 Fibonacci. Easy. Trades from the 61 Fibonacci, you want to put your stop loss at the 92.5. We will go over some trade examples in the next slide as to what they are. And then the TP will always be the high or the low. So if we look at these examples here, these are examples fresh off my old tracker. You can see here, break and retest, EMA, all yellow candles, pullback candles, all white. Enter the trade with a pending order. Stop loss was at the 92.5. TP was hit down at the low, and that right there is a 2 risk to reward. Identical setup in the middle here, an identical setup on the bottom left, identical setup in the middle. And then these 2 examples to the right here, we've got a 38 fib here, break retest, EMA, stop losses at the 61 fib. That will give you about a 1.5R. Same again with this example at the top, break and retest of the high, EMA was in direction of our bias, stop loss was at the 61 fib, and there we go, we got a TP for 1.5R. If I go onto this tracker here, the results literally speak for themselves. So as you can see, these here are from 2021. These are the results that are here. Anything that is in orange means it happened overnight, so I wouldn't have taken it. Anything in blue isn't a trade that I personally would be taking during my trading sessions. Okay, so if we have a look, this is week by week, by the way, guys. So as you can see, there are a lot of trades that you can be taking. Some weeks like this, if you look to the bottom right, you've got 10.8. So imagine 10.8R in a week, just based off taking 6 trades. Unreal stuff. And then as you can see, we had data upon data upon data. What we used to do, at the end of every week, we would get on a call with the community. They'd be able to send in trades that they took. I would be able to assess that trade and say if it was valid or not for the strategy, and then people could learn from that. So like I currently do now, if you are looking to learn a strategy and be part of a community where it's there to actually help you, click the link in the bio on Learn to Trade, join the community, get access to the content, and then obviously look to take your trade into the next level. But if we look overall at the stats, this is month by month. So these stats that you're about to see are absolutely crazy. Okay? I know some people are probably going to doubt them, but they're absolutely wild. February. If you would trade just the London session, you'd have done 20.7R or 20.7%. New York session, you'd have done 9%. Asian session overnight, you'd have done 15%. Obviously, if you'd have traded all sessions, you've got a total of 44.25, but no one is going to be doing that. We're just going to base it off the London and New York session. So February, you had a 29.25% gain or a 29.5%, R multiple, depending what you were risking. Going into the next month, March, exactly the same. London would have done 19.6. New York did 4.5. Asian did -2 for a grand total of 22.6. Assuming you only traded London and New York like we did, you have a 24R month. Going into April, London 21.9, New York 11.5, Asian 2.2. So you can see that this strategy mostly works in the New York and the London session. That would have been pretty much a 24R month. And then going into May, a little bit slower. You had 20 trading days. You only had about 8 trades, and you've done 5%, 3%, and -2 based off the sessions you traded. Overall, London and New York was still an 8R or an 8% month. And then if we go further down, this right here, this is June. So just based off June, if you were to trade London and New York, let me just add them up for you. Over the course of 4 weeks, you'd have had a 20.5R month. So historically, in 2021, this strategy right here was doing on average 20R a month, which is absolutely crazy. I still don't understand how this strategy did so well. It was mechanical, it was simple, and if you are able to have the screen time and stay on screen and check the chart, if you're on the 15-minute, obviously every 15 minutes. If you wanted to do it on the 1 hour, do it on the 1 hour. Just whenever you can check the charts, have a look for these plays, see if they play out. And honestly, guys, just let me know how you get on, because historically, this strategy was really, really good. So I'm hopeful that this has been beneficial and some of you can go away and, make some money off the back end of this. As I mentioned kind of mid-video, if you are looking to learn the way I currently trade based on the 4-hour pending orders, meaning that if you have a full-time job, you don't need to be sat at the screen, click the link in the bio, join the curriculum, join the community. We'll be happy to have you. And obviously join like-minded traders, obviously striving to get them payouts, get them funded accounts, but also grow your live account. So any questions, guys, please let me know in the comments, and I'll see you in the next video.